Hello, Assalamu alaikum, dear students. We are back in Unit 6 again. So we have covered so far Unit number 6.1 and 6.2. And in this unit, which is Unit 6.3, we will going to discuss about Federal Reserve System. And here, the important topic which we are going to discuss in Federal Reserve System is the central banking system, which has been developed in 1913 after the Federal Reserve Act, which came in the end of December 1913. Remember this, that Federal Reserve System is based on fractional reserve banking system, and it is also the central bank of the United States. So let's start our today's topic. This is unit number 6.3. Before going through the Federal Reserve banking system, there are three different terminologies which we're going to use one by one. So when we're saying central bank, remember this is an institution that oversees the banking system and regulates the money supply. So it means it's a banker's bank, and it is regulating all the commercial bank or depository and non-depository financial institutions who are registered with them, or known as scheduled banks. They also create or they also create a monetary policy, and the policymakers set, and when they set back and sit together, how many policymakers are there in central bank, we're going to discuss later on. Setting of this money supply, that how much money supply should be in the uh, economy. When we are saying money supply, it means we are talking about currency in circulation plus demand deposits. Remember this. Usually these terminologies always remember. So how much money supply should be? So do we have to increase the money supply or decrease the money supply, and how we usually do it? We will discuss later on in this subject, in this chapter. So when the policymakers are making this, there is a committee called Federal Open Market Committee of FOMC, which is consist of some of the board of governors and some Federal Reserve Bank. How many are they? In next slide, we're going to discuss. Federal Reserve System is the central bank of United States. Now, just a glimpse or a picture which will give you an idea about that Federal Reserve System. When we are saying Federal Reserve System, we are talking about the United States Central Bank, which consists of three basic entities. Um, Number one is Federal Reserve Board of Governors. In short, we called it BOG, Board of Governors. 12 Federal Reserve Bank, FRB, and Federal Open Market Committee, FOMC. So these are the three main key entities which comprises or create a Federal Reserve System. These terminology will going to be used a lot, and sometimes in short we called it simply Fed. Federal Reserve System consists of three entities: Board of Governors. In Board of Governors, we have 7 members located in Washington, D.C. So their office is located in Washington, D.C., where 7 Board of Governors or 7 members or 7 directors are there. This is how the Board of Governors are serving. Remember this, their tenure is 14 years. So they are on a contract for 14 years, and they remain on the seats as a member and worked as a Board of Governors. 12 regional Federal Reserve banks are there. They are located in different states. So in United States, there are many states. So in different states, Federal Reserve banks are there and their sub banks are also there. Remember this. So the chairman uh, directs the Federal Reserve staff and presides over board meetings and testifies regularly before Congress. So when they meet the Congress, before that they sit together and step by step the chairman leads this meetings and they supervise how to control the money supply. But how many members are there? Remember this, the last committee which we were discussing, who uh, created monetary policy. It includes board of governors plus Federal Reserve Bank members. So how many members came from the Federal Reserve Bank and how many from Federal Board of Governors? This is what you have to learn here, little bit about it. FOMC includes Board of Governors and also the president of some of the regional Federal Reserve Bank. Remember this, the New York Bank, in New York, we have Federal Reserve Bank. In other states, we also, whoever is going to be the New York member must include in this FOMC committee, and they decide the monetary policy in a country. So the 7 Board of Governors came in this committee when the committee is going to be created, and this committee has 12 members. So the 7 members belongs to Board of Governors, and we know that Board of Governors are only 7. So all these members include in that committee. Plus, out of those 12 Federal Reserve Bank, only 5 members will going to be included. So 7 plus 5 becomes 12. So FOMC committee contains or have 12 members, 7 Board of Governors, and 5 from Federal Reserve Bank. But remember, 1 which is from New York must be there in that committee. So 4 will be from other states and 1 will be the New York member. When we are talking about bank reserves, remember this, that we will going to discuss about fractional reserve banking system because it's a central banking system, and the central banking system or Federal Reserve banking system based on fractional reserve banking system. And this is a huge topic and you should always memorize this topic and try to understand it deeply. If you have the money creation process, that how money is created with the fractional reserve banking system, go to YouTube, read different books and try to create your concept related to fractional reserve banking system. It is very, very important to have the exact sense. Usually people don't know this, what is fractional reserve banking system. So hopefully at the end of this unit, you will learn a little bit, but you have to read at least 2-3 times to understand this concept. So banks keep a fraction of the deposits. It means what they are saying, if 100 rupees is going to be deposited into a bank, a fraction of it, fraction means a little bit of it. So for example, 100 rupees has been deposited, 10 is a fraction. So fraction is going to be kept or kept as a reserve, and the rest will going to be loaned out to public again. This is how banks create money. But later on, we will going to discuss this is in detail. This is just a glimpse. So bank keeps a fraction of the deposits as if reserve and use the rest of the money to create loans. The Fed establishes this reserve requirement, that how much fraction is going to be kept into the bank or against those deposits. So these regulations on the minimum amount of reserve that banks must hold against deposits. Banks hold or may hold more than this minimum. So for example, 10% is the reserve requirement. 10% is the reserve requirement. So if 100 rupees is going to be deposited, so 10 rupees must be maintained in the form of reserve. But bank may hold more than this amount. It means that they can have 15 rupees deposit in the form of reserve, or maybe they can keep it like 20 rupees. But the minimum amount is this, which is 10%. Maximum, there is no limit. They can even keep 100 rupees to 100 rupees in the form of reserve. Whatever reserve is above that percentage is known as excess reserve. Remember this, we will going to discuss it later on. Here you can see on your screen different examples. The reserve ratio, when we're saying 10%, so if you have deposit $100,000, $1 lakh, so 10% is 10,000. This is the minimum requirement bank must keep. So the fraction of reserve which is going to be kept, this is 10% reserve requirement. Bank holds this, and the rest, which is $90,000, will going to be loaned out in the public. Let's take an example. Here on your screen, you have a T account or a bank's balance sheet. Here we have taken this example from the book so that once you read the book, you can easily grasp this idea from the book of Mankiv. First National Bank, we know this assets always equals to liabilities plus equity. So right hand side is equals to left hand side, or left hand side is equals to right hand side. That is why this is known as balance sheet. But how the balance sheet looks like, remember this when we talk about any bank's asset side and liability side. So if 100 rupees is going to be deposited into the bank, so this is the bank's liability to pay to this depositor. When the deposit comes, it becomes liability and it comes in the asset side also. This is known as reserve. So they have created reserve against the deposits. Okay. So deposits are there, reserves are there. Now, do they have to keep this 100 rupees reserve? Answer is no. They only have to keep the minimum requirement, which is usually 10%. It may vary 5%, 3%, 7%, 15%, depending on how the monetary policy will going to utilize. So for example, we are taking an example that the 10% reserve requirement is there. So out of this 100 rupees, when they have 100 rupees reserves, they have created against deposits, so they can keep 10 rupees in the form of minimum reserve requirement. And as I said it earlier, they can easily give 90 rupees in the form of loan. So when they're giving loan, for example, 90 rupees is going to be loaned out to other public, the balance sheet will looks like this. So 100 rupees, now we have example of dollars. So $100 is going to be deposited, out of which $10, which is the 10% minimum requirement. So they have kept it in the form of reserve. Initially, it was $100 reserve. So $100 can be subdivided into two categories. One is called minimum reserve requirement, and the other remaining amount is called excess reserve. So excess reserve can be loaned out, and minimum requirement reserve must be kept in the balance sheet. So they have kept this minimum requirement, and rest is going to be loaned out. If you wanted to find out what is the reserve requirement percentage, so you can easily calculate it by simply divide this reserve with your deposits. So $10 divided by 100 multiplied by 100 will become 10%. So you can convert it into a percentage. Now, what is fractional reserve banking system? This is a key concept, and I will I would like to say that you must go to YouTube or different books and try to understand this concept. So how did the money supply suddenly grow in this fractional reserve banking system? This is very, very alarming, and we have to live with this system. When banks make loans, they create money. How? Because when they're giving loan to public, it goes in the hands of other persons in the form of loan. They use this money for buying goods and services, and then again, those who get this money will deposit again. So this is again create a spiral effect or recurring type of effect. How it happens, we will going to see here. The borrowers get this $90 currency. Whoever is going to borrow, when the banks loaned out, borrowers will get this money. When they get this money as an asset counted in the money supply, the new debt is going to be created. And when they are creating this debt, a liability that does not have an offsetting effect on money supply, this is known as fractional reserve banking system, which creates money but not wealth. How it is going to be happened, I'm just trying to revise the concept of unit 6.2, that the money supply includes currency in circulation, which is in the hands of public, and depositors' money, which is in the banks or lied in the bank, also known as checking accounts. So let's take an example and try to understand this concept of fractional reserve banking system, how they create money. So we have depositors who has deposited $100, and borrowers get $90 in currency. When borrowers get this $90, when they created loan, bank created loan, whoever is going to receive this $90, the currency in circulation will going to rise. Depositors' money was 100, so $90 plus $100 becomes $190. Although it was only $100, but because of this system, reserve banking system or fractional reserve banking system, when they loaned out, the currency in circulation will start increasing. So borrowers get more money, and this is how they create money. The story is not going to stop here. How this $100 deposit converted into $1,000 of money supply with this fractional reserve banking system. Try to understand this concept. Initially, $100 was deposited, $90 given in the form of loan, and whoever is going to borrow that money, they will going to purchase goods and services, and whoever is going to sold out those goods and services will definitely have this money, and they will certainly deposit into another bank. So when they deposit this $90 into another bank, the deposits will going to rise. It creates excess reserve, out of which $81 will going to be loaned out, while $9 will going to be kept in the form of reserve. So this is the balance sheet I have drawn it for B2, another bank. How this $90 came here in the form of deposits? When people has this money, they utilize it. We were going to use it in the next slide with the picture so that you can understand this concept more and more. This will continue from one bank to another bank. Whoever gets the money, they will going to create reserves, and out of that reserve, they will keep a fraction of reserve, and then the rest is going to be loaned out. In the end, this $100 deposits becomes $1,000. To understand this concept more, we have this animated picture so that you can understand this concept. So here, rather than taking $100, now we are taking an example, $100,000, $1 lakh. So when a person, Alice, deposits 100,000 into a bank, it means 100,000 reserve has been created. $100,000 deposited. This is a liability. On the asset side, $100,000 reserve is going to be created. But this is too much reserve. They just have to keep minimum balance or minimum requirement, which is 10%. So $10,000 they will keep, and the rest 90,000 they will going to loaned out. So here you have this 90,000 loaned out. Whoever is going to get this money, they will use it for the transaction to buy goods and services, and the seller will get this 90,000, and they will not going to keep it in treasure or in their wallet. They will definitely find out their banks, and they will deposit this amount into another bank. So first, the Alice deposited this amount, and Joey, who is the seller of goods and services, get this 90,000, and Joey deposited this into another bank. Whoever or the bank, when they get this 90,000, the minimum balance requirement is 10%, so 9,000 will going to be kept here in the form of reserves, minimum reserve or reserve requirement. Rest is going to be loaned out to another person. Again, when the borrower gets the money, they will use it for buying goods and services. And from Joey, started from Alice. So first Alice deposited, Joey gets the money, Joey deposited, and now another seller got this. And here, remember this, when they have this $81,000, the seller, who is Louis, will not going to kept it in his pocket. He will definitely deposit it into another bank. So 81,000 is going to be deposited into another bank. Bank's minimum reserve requirement again is 10%, which is $8,100. The rest will going to be loaned out. This process will going to go one by one in the form of a spiral, and it will continue. Right now, it's only 271,000, but at the end, the result will show that this 100,000 deposits converted into 1 million dollars. Just remember, it's approximately 10 times. So this is how banks create money through fractional reserve banking system. So they keep the fraction of the reserve, and the excess reserve, whatever they have, they loaned out. And once they loaned out, those borrowers will use it. And this is continue one by one until unless it reaches to 10 times when the rate is 10%. Here, our topic has been finished, which is slightly longer, but I have tried my level best just to give you an idea, but still just watch different videos and go to different books and try to find out this concept in detail. Thank you very much. We will come up with another video.